We're live.
We're live. Great. Cool.
Hello, everyone. I'm here with Ryan Cynoski with Premier Members Credit Union. Ryan is one of my preferred lenders. He's fantastic. He also has his CPA license. And on that, he just taught an amazing tax reform class that I unfortunately missed, but he's got some amazing things to share with everyone.
Yes. Thank you, Chelsea. Thank you. So, like you said, I'm a mortgage lender, first and foremost, with Premier Members Credit Union. And I do have a CPA license. So, a lot of times I'll be charged with figuring out tricky loans that deal with self-employment income. A lot of times I'm working with my real estate agent partners who have questions of their own. So, I think if we can spend a little time today just talking about a couple of the tax reform impacts that are helping and potentially hurting individuals as they're looking to buy homes and real estate agents, then I think that would be pretty helpful.
Yeah, absolutely. This is not an area that I specialize in at all. We literally throw everything at our CPA and just like pray that it's done right. So it's always great to learn something new every day. How can it help us with our biggest purchase of our life, right? And then making investments in real estate. That's one of the best places to put your money. So, okay.
I couldn't agree more. Yeah, I couldn't agree more. And I don't want to surpass that comment you made about delegating that responsibility of doing your taxes to your CPA. I think that's a really great thing to do, to have a CPA on your team. That individual is always going to be available to serve you throughout the year as things happen. It's really nice when you can make decisions proactively before you buy a house, before you get that new debt, before you start that new business. Bouncing some ideas off your CPA is a really great way to make sure that you're growing your financial self in a really healthy and positive way. So kudos to you for that.
Thanks.
So I just want to hit, I've got a little cheat sheet here on the side. So I just want to hit maybe 5 or 6 topics that I think are really important. And the objective here today is just to help you and others understand what's going on in the tax world, not master it. You just need to have a little bit of exposure and awareness to some of these things so that as you're talking to your friends or your clients, you're coming forward with some intelligence. So
Right.
The first thing is the forms themselves. The forms themselves have completely changed. Right now, we have a form that a lot of people in the beginning were calling the intention for a postcard return. That basically means that the whole return on 2 sides can fit on half a sheet of paper. So it's a little bit bigger than a postcard in actuality, but the form used to have, now I'm talking about the personal 1040. Your personal 1040 used to span 2 full pages. Now it does not. It spans 2 half pages. So the first half is really the part that's about you, the individual. It's got your name on there, your dependents on there, and your signature, and not a whole lot else. There aren't a lot of numbers on the first page. On the second page, there are all of your numbers, where your income is coming from, some of your deductions, your tax liability. So the numbers are really summarized on the back. That's a lot different than years past. And what's really scaring people is that the back page doesn't tally in a column. You can't go through and add up all of the numbers in the column and total out to the bottom. And that's because they've peeled out some of those calculations and put them on separate schedules. So now, moving forward, we have our short return, our 1040, and we have a supplement of 6 different schedules. I'm not going to go through what the 6 schedules are. It's not really relevant. Most of us are going to use tax software anyway, so it doesn't matter. But know that not all of the information that used to be on the face of the 1040 is there anymore. Now it's on that half page, and then you've got the schedules. Forms are different. Okay, so the next thing that's different is that you have personal exemptions. In the past, we used to get a deduction, and it used to be some, $4,000 per dependent that we were able to deduct from our income, and it helped improve our tax liability. That's gone. There's no more of that. But what is better, arguably, is that we've got a really large increase to our standard deduction. So married filing jointly, you would have been able to deduct somewhere around $12,500 in previous years. That's now doubled to $24,000.
Oh, wow.
Yeah, it's really helpful. As it relates to the folks that are out there looking to buy homes, I definitely support deducting your mortgage interest. But please know that now that your standard deduction is so high, the mortgage interest deduction that you would take isn't the same advantage that it used to be. Which it doesn't mean that buying a home is a bad idea. That's not what I'm saying. But it doesn't have that same advantage anymore. The standard deduction is really high, and it's usually above the amount that you'd otherwise deduct for mortgage interest.
Okay.
Cool?
Yes. I'm squinting because I'm thinking. This is like my thing because I have to process it, and I'm making notes right now. So when I look down, I'm taking notes.
Okay.
This is mostly for my benefit, this video is.
So the next thing is, in years past, we used to be able to deduct about $1.1 million of qualified mortgage debt. And by qualified, I mean it had to be secured against your primary residence or your second home. $1.1 million was broken into two parts. It was $1 million on your acquisition debt, your permanent financing, but then you were able to get a HELOC, and up to $100,000 of your HELOC interest was deductible too. So a lot of people were abusing that, if you can call it abuse, and they would get a HELOC, and they'd take a bunch of money and go on vacation.
Yeah.
And then they would start deducting the mortgage interest from the HELOC on Schedule A. So that was really aggressive. And we've put an end to that. So you can no longer deduct mortgage interest associated with a HELOC that was not connected to the purchase or improvement of a home.
Okay.
You can still, so there's a misconception around HELOC interest deduction. You can still deduct it, but it has to be related to the home.
Okay.
Now, the new threshold is only $750,000. So that's inclusive of a $100,000 HELOC. So you can't add the HELOC on top of the new threshold of $750,000.
Okay.
And what's also, yeah, go ahead.
Oh, yeah. So that's like all a part of your bookkeeping, because like how does everybody know that you just don't take a vacation? Is that like, so I've got multiple lines of credit open and I've been using them to buy other properties.
Right.
And I just track that.
What you're going to see this year that's different is the financial institutions that are issuing the 1098 int form, the little form that tells you about what your total interest was.
Yeah.
That form has changed.
Okay.
And there are a few new boxes on there. And some of the new boxes help identify what property the interest is related to. And those forms have changed to help people comply and adhere to this new rule, and to help CPAs and tax professionals prepare returns in conformity with the new rule. So it's kind of a bit more transparent.
Okay.
Yep.
Okay. Cool. Yeah, that makes sense why my CPA asked for that stuff. I'm like, okay, whatever, here you go.
Okay, so the new limit is $750,000 of qualified mortgage debt can be deducted. The interest can be deducted on Schedule A. So that's a lower threshold. Not great, but whatever. What's important to know is that if you have a client or you yourself have qualified mortgage interest debt that you're carrying over into this new tax year, which is 2018. I realize that we're in 2019 right now, but 2018 is the year for which we're all filing taxes. Right. So if you're carrying this mortgage debt of over $750,000, if you're carrying that over into the new year, you can still, you're grandfathered in basically. You can still deduct that mortgage interest.
Okay.
Where it gets really confusing is if you did have a loan of $1 million or more and you grandfathered it in and you're still deducting the mortgage interest and you decide that you want to do a refinance. Do you have to adhere to the new rules, or does your grandfathering endure? It endures.
Okay.
It endures, which is really good. But sometimes what will happen is if you got $1 million of mortgage debt and you over time paid that principal balance down, and now you want to refi but do a cash out, maybe back up to $1 million. This difference of cash out is not eligible for the deduction. That portion is not going to be grandfathered. Only this part down is still eligible.
Okay. Is there a limit to how many homes that, because like in different states, I mean, obviously if we've got $1 million in real estate debt in Colorado, that maybe is 2 homes, maybe 3 if you really push it. But like my portfolio is spread out across a couple states, so I have a lot more homes covering that million.
That's a great question. So the answer to your question, I'm going to peel it in 2 parts and remind you that part of that is you as an individual, and part of it is you as a business, right? Part of those assets are really in your portfolio that we're treating like a business. And we'll talk about that in a second. But the assets that are you as an individual are your principal residence and your second home. And you get 1 of each.
Okay. I don't have a vacation home.
Well, you could, and you could have more than 1 vacation home. There are plenty of people out there that have a lot of second homes.
Yeah.
So the rule with that is if you have more than 1 second home, pick 1.
Okay. Okay.
Now, all of the other assets in your portfolio, all of your other assets in your portfolio, all of your other rental properties, you still get to deduct the full amount of the mortgage interest on those.
Yeah.
That's done somewhere else. That's on your Schedule E.
Okay.
So that's you as like a passive business. Well,
Okay.
You as a real estate professional qualify for a really particular section of the IRC that allows you to be a qualified real estate professional and puts you in a little bit different position when it comes to deducting passive losses from your rental properties. I'm not going to go super deep into that right now.
We kind of touched on this a little bit earlier, and it's not necessary. I mean, obviously I'm a full-time agent with, a rental portfolio on the side, but it's anybody who spent, would you say 750 hours within your real estate umbrella? Mm-hmm. So not necessarily out buying and selling with clients or within your management.
So let's take this piece by piece. So there's a section of the Internal Revenue Code that allows qualified real estate professionals to treat the losses of their rental properties differently than other people who are not qualified real estate professionals. And what we're really talking about here is the difference between active income and passive income. When you own 1 piece of real estate, the money that you're making off of that is really passive income. I get it, you're marketing it and you're dealing with the tenant a little bit and all of those things, but generally speaking, you don't show up for 40 hours a week. You don't clock in, you don't clock out. This is passive income. And you call that a portfolio yourself, right? Like a portfolio is a pool of assets that are generating for you passive income. Right. And when you have those, you generally want to only deduct passive losses against passive income. So when you have a big portfolio, it's not unusual to see somebody with a lot of mortgage interest deduction, repairs and maintenance, advertising expense, and most importantly, depreciation, generating a loss. It's not unusual to see a loss generated on your tax returns for your assets. Right. Depreciation is one of those non-cash expenses, right? Like you're not shelling out money for depreciation. Depreciation is just a representation of the use of that property and its wear and tear over time. Right. So you're getting a tax deduction over that. I think it's 27 and a half years that you're dividing the useful life of your rental real estate over to get your depreciation. So if you've got a bunch of losses, you might have to suspend those losses and not get to take them off of your income, meaning they're not helping reduce your tax liability. Okay. And generally speaking, that's not good. Yeah. But a qualified real estate professional is somebody who works in industry. I think you have to work more than half of your work has to be in the nature of real estate trader business. Oops, sorry. I know we're live.
Where'd you go? Pause. Okay. And live again.
basically half of your work has to be as a real estate professional, and then you have to do at least 750 hours in that field. So if you meet those criteria, which many real estate agents do, now all of a sudden this income is active income, and you can deduct those losses against your active income. So that's really good. That's really important for the real estate agents out there to know this.
Yeah.
Okay.
Yeah.
Now, you asked me a question earlier today, and I got the answer to this. You said, well, what if I don't have a giant portfolio? What if I'm just an individual and I have one rental property?
Yeah.
I'm jumping ahead here to the qualified business income deduction, the QBID thing. So let me put a pin in that, and let's talk about QBID real quick, okay?
Okay.
So this year, probably the most impactful change to the tax reform, short of no dependent deductions, huge increase in standard deductions, and the limit on qualified mortgage interest deduction. I'm not going to talk about the state and local tax deduction limit of $10,000 because in Colorado we have a income tax of 4.63% flat, and people do get hit with the SALT limitation, but it's not going to be catastrophic.
Yep.
So what is going to be really impactful is this qualified business income deduction. So this is a deduction that the Tax Cut and Jobs Act allows. So you can take your net income, right? When a business makes income, they have revenues, then expenses, and then this number down here is the net.
Mm-hmm.
Take this number, multiply it by 20%, and then you get that deduction once over again on the face of the 1040. It's like a bonus. It's incredible. So if you're self-employed, you really got to talk to your tax professional and see if you qualify for QBID. You probably do. For the real estate agents out there that are listening, you guys do qualify for this, and that's really special because you guys are in a service industry, and a lot of service industry professionals were limited and blacklisted from the ability to take this deduction. But NAR, what is that? National Association of Realtors, they lobbied super hard to make sure you guys stayed off that blacklist. So you're psyched about that. You guys are going to qualify for this QBID deduction.
I already saw it on my returns this year, or 2018. Yeah, it was pretty awesome.
It's a huge benefit. So there are some limitations. If you're a really, really high earner or you have some other complexities or a funky structure to your business, you want to be careful that you don't have some limitations. But the tax software is going to help you through that. And if you have a tax professional, they're going to help you too.
Yeah.
Okay, so QBID, 20% deduction. You asked me, what if I just have one rental property? Can I take QBID on that? And the answer is probably you can.
Very gray.
Well,
Great answer.
We're going through this tax reform environment, and there isn't a whole lot of guidance out there from the IRS.
Yeah.
So we're putting guidance out as needed. In 2019, or I should say in late 2019, early 2020, we'll get a lot of guidance after everybody files their returns and the IRS sees where all the loopholes are and they'll start tightening them up. But right now they did put out one piece of guidance, and that piece of guidance was in Notice 2019-07. In there is a safe harbor. And the safe harbor basically says that if you have one piece of real estate that you're listing on your Schedule E, if you can prove that you're keeping a set of separate books and a separate bank account, and you can identify at least 250 hours that you've put in to this business, now we're talking about active income again, and you will qualify. You will qualify for the and if you have a management company, right? If you have a management company, they're essentially your agent. So the hours attributed to your property qualify to help you eat up that 250 limit.
Okay, I was about to ask that because half our stuff we've got with various property managers. So you can start counting their hours as your hours.
There you go.
Yeah. Wow. Okay. Well, this was very helpful. A lot. I mean, well, we're going to have to talk a lot more about this because I'm waving over my head because it's just like a lot. But I feel like I know a lot more. This is helpful. Hopefully it's helpful for the two people watching this. Hopefully we got more. We'll push it out.
Right on. Cool. Well, thank you for doing this with me. And
yeah, this is great. Love your knowledge. All right. Take care. Appreciate it.
Cool. All right, Chelsea.
Thank you. Bye.